Lately, I've been thinking a lot about retirement, not my own. I'm 94, and I have no intention of retiring. I mean, retirement as a system. How people plan for it, how they fund it, what they get right, and what they consistently get wrong. And here's the problem I keep seeing. Most people approach retirement backwards. They work for 40 years, save whatever they can, and then simply hope it's enough. No real structure, no clear plan, no intentional asset strategy, just optimism. But hope isn't a strategy, because when you hit 65 and finally realize the numbers don't work, you don't get a redo. You've run out of time. You've lost the most valuable resource retirement planning depends on: compounding years. At that point, fixing the problem becomes painfully difficult. So today, I want to be direct. There are 5 assets you must have before you retire. Not nice to have, not maybe, must. If your goal is a secure, comfortable retirement, one built on confidence instead of fear, these 5 asset categories need to be represented in your portfolio. And I'm not talking about hedge funds, complex derivatives, or strategies that require constant monitoring. These are straightforward, time-tested assets that have worked for decades. They do 3 essential jobs. They generate income. They protect purchasing power. They give you stability across unpredictable markets. Let's start with the first and most important asset. 1. A diversified portfolio of high-quality dividend growth stocks. For retirement income, the foundation is not bonds, and it's not annuities. The foundation is dividend-paying stocks, specifically dividend growth stocks from companies with long track records of increasing dividends. Here's why. When you retire, you need income. Real income you can count on, because you're no longer receiving a paycheck. There are only 2 ways to fund retirement from investments. You sell shares, gradually reducing your principal, or you collect cash flow from the assets you own without selling. If you're relying on selling shares, you're living on a countdown clock. Eventually, you draw down your portfolio far enough that market drops become dangerous. And if you live longer than planned, as many people do, you can outlive your capital. Dividends solve that problem differently. With the right companies, dividends can continue indefinitely. You hold the shares, and the business sends you cash quarter after quarter. And if those dividends rise over time, your retirement income rises with them. This is why quality matters. You're not looking for high yield at any cost. You're looking for stable businesses with durable earnings and a history of increasing payouts year after year. Think of companies with strong brands, strong balance sheets, and long dividend records. Businesses that have increased dividends for decades, not years. Names like Coca-Cola, Johnson & Johnson, Procter & Gamble, and McDonald's are examples of the type of company I mean. Boring, stable, consistent. That's what you want in retirement. Reliability. Now consider the math. Say you retire with $1,000 invested in dividend-paying stocks yielding 3%. That's $30,000 a year in income. On its own, that might not be enough. But the key isn't the starting income, it's the growth rate. If those dividends grow at 7% a year, the income changes dramatically over time. After 5 years, you're collecting around $42,000. After 10 years, roughly $59,000. After 20 years, well over $100,000. That's the compounding effect most people ignore. While programs like Social Security often struggle to keep up with real inflation, dividend growth can outpace it, because the underlying businesses increase earnings and raise payouts. And here's the overlooked benefit. You didn't have to sell a single share to generate that income. Your principal stays invested. It can continue growing, and it can be passed on to your family. The dividends are income generated by productive companies, not money you withdrew from yourself. I've relied on dividends for most of my adult life. Berkshire Hathaway doesn't pay a dividend, but I've owned many businesses that do. And what I've seen year after year is that dividend income, when it comes from strong, profitable companies, is among the most dependable income streams you can build. So asset number one is clear. Build a diversified portfolio of quality dividend growth stocks before you retire, not 2 or 3 names. Think in terms of 10, 15, even 20 companies across industries selected for durability, not excitement, and plan to hold them for the long term. That becomes your retirement income engine. 2, a low-cost S&P 500 index fund you don't touch. Now, the second asset category seems like it overlaps. People ask, if dividend stocks are the income engine, why do I also need an index fund? Because you need both roles covered, income today and growth over time. Dividend stocks provide cash flow you can live on, but your retirement still faces risk. Inflation spikes, unexpected medical costs, market volatility, or simply living longer than expected. You need a separate pool designed to grow quietly in the background, an asset you can tap only if needed. That's what a low-cost S&P 500 index fund does. It gives you broad exposure to 500 of America's largest businesses. You're not making individual stock bets. You're owning the productive core of the U.S. economy. Over long periods, 20 or 30 years, it has historically provided strong returns. And it's simple. No constant decisions, no active trading, no obsession with headlines. You buy it, you hold it, and you let time do the heavy lifting. Here's an easy way to think about the structure. Your dividend portfolio is like your checking account. Your index fund is like your savings account. You live off the dividends. You don't touch the index fund unless you truly have to. For example, imagine retiring with $700,000 in dividend growth stocks and $300,000 in an S&P 500 index fund. The dividend stocks provide the ongoing income. The index fund compounds quietly. Over 20 years at long-term historical returns, that $300,000 can potentially grow into something far larger, possibly into the millions, while your dividend holdings are still paying you income the entire time. The result is a portfolio designed for real life. Income to live on, growth to protect your future, a buffer for emergencies, a structure that doesn't collapse if one component has a bad year. So asset number 2 is a low-cost S&P 500 index fund you hold long-term and avoid touching, except in true emergencies. 3, income-producing real estate, or REITs. The third asset you need before retirement is real estate that generates rental income. And I need to be precise. I'm not talking about your primary home. Your home is not an investment portfolio asset. It's a lifestyle choice and an expense. It may rise in value, but it doesn't pay you. It costs you taxes, insurance, repairs, maintenance. What matters for retirement is cash flow real estate, rental property, residential or commercial, that produces monthly income. The reason is simple. Rental income tends to be stable, and it often rises with inflation. People always need places to live and operate. And when the cost of living rises, rents usually rise too. That means real estate can protect your purchasing power as your retirement expenses increase. Real estate also adds diversification. It's not perfectly tied to the stock market. When stocks fall, rental properties often continue doing what they do, generating income. Tenants still pay rent. That stability matters when you're no longer earning wages. Now, not every property is a good deal, and being a landlord isn't effortless. There are headaches. But there is a reason real estate has been a wealth-building asset for centuries. It can produce income while preserving value. And if you don't want direct ownership, you can use REITs, real estate investment trusts. These are businesses that own and manage income-producing properties and pay most of their profits out to shareholders. You get real estate exposure without handling tenants and repairs. Either way, you want real estate exposure in retirement. Asset number 3 is income-producing real estate, or REITs. Cash flow that tends to rise with inflation and provides diversification. 4. Inflation-protected government securities, TIPS or I-bonds. The 4th asset is specifically designed to handle one of the most underestimated threats to retirees: inflation. Traditional bonds are often presented as safe, but in an inflationary period, they can be quietly destructive. Fixed payments lose purchasing power as prices rise. TIPS, Treasury inflation-protected securities, work differently. Their principal adjusts with inflation. If inflation rises 3%, the principal value rises about 3%, and interest is paid on that adjusted amount. The goal is simple: protect purchasing power. Why does this matter so much? Because inflation slowly ruins fixed income retirement plans. If you retire with $50,000 a year and inflation runs 4% annually for a decade, you lose a major portion of what that income can buy. Your $50,000 ends up functioning like roughly $33,000 in real terms. That can turn a manageable retirement into a stressful one. TIPS and I-bonds provide defensive stability. They're not your main growth engine, but they protect part of your portfolio from inflation surprises. A practical allocation might be 10–20% depending on the person. Not the majority, because stocks and real estate generally outpace inflation long term, but enough to provide insurance against worst-case inflation scenarios. Think of it like this: stocks and real estate are offense. TIPS are defense. Asset number 4 is TIPS or I-bonds, inflation defense built into the portfolio. 5. A paid-off home or very low housing costs. The 5th asset surprises some people, especially because I said earlier your primary home isn't an investment. That's still true. But a paid-off home is one of the smartest financial positions you can carry into retirement, not because it grows, but because it dramatically reduces your largest expense. Housing is usually the biggest cost in retirement. If you're paying $2,000 a month in rent or mortgage, that's $24,000 a year. Over 20 years, it's close to $500,000. If you own your home outright, your housing cost falls to property taxes, insurance, and maintenance, maybe $6,000 to $8,000 a year instead of $24,000. That difference changes everything. It lowers the income you need to retire. It reduces stress in down markets. It creates flexibility for medical expenses or emergencies. So if you're approaching retirement with a mortgage, paying it off should be a serious priority. Not the car, not the kitchen remodel, not the vacation, the mortgage. Yes, the math sometimes says investing beats paying off a low-interest loan. But retirement is not purely a math equation. It's about security, peace of mind, Knowing you have a place to live that cannot be taken away because your monthly payment became unmanageable. If you're younger, the strategy is straightforward. Buy less house than you can afford. Choose a shorter mortgage if possible, and pay it down aggressively. Aim to have it paid off by 60, earlier if you can, so you can spend the final years before retirement building the other assets without a mortgage draining your cash flow. If you're older and the mortgage is still large, you have to make a decision. Pay it down with urgency, work longer if necessary, or plan to downsize and eliminate the payment. What you can't do is retire with a large mortgage and hope it works out. Retiring with a big mortgage payment is one of the easiest ways to turn retirement into financial pressure from day one. Asset number 5 is a paid-off home, or at least very low housing costs, because it makes the entire retirement plan far easier to sustain. Recap: the 5 essential retirement assets. So let's summarize the framework. Dividend growth stocks, your primary income engine, growing over time. S&P 500 index fund, long-term growth and backup capital. Income real estate or REITs, stable cash flow that often rises with inflation. TIPS or I bonds, inflation protection and stability. Paid-off housing, lower expenses and higher flexibility. These 5 assets work together because they each protect you from a different risk: market crashes, inflation, longevity, and unexpected expenses. And once you understand that, the next question becomes obvious. How much should you have in each category? And how do you avoid the common mistakes people make? When you put these 5 assets together, something important happens. Your retirement stops depending on luck. Market crashes, your real estate income and inflation-protected securities remain relatively stable. High inflation, your dividend-paying companies and rental income can adjust upward over time. Living longer than expected, your index fund continues compounding in the background. Unexpected expenses. Your paid-off home keeps your baseline costs low. That's not hope. That's structure. It's a retirement built on confidence. Confidence rooted in assets that have proven themselves over decades across wars, recessions, inflationary periods, and market booms. Now, knowing what to own is only half the equation. The other half is knowing what not to do, because I've seen people with decent savings still fail at retirement due to avoidable mistakes. Let me walk you through the most common ones. Mistake 1, putting too much money into bonds. Many people hear the word retirement and immediately think conservative, so they move heavily into bonds. That instinct is understandable, but outdated. Bonds don't grow meaningfully over long periods, and they perform poorly when inflation rises. In inflationary environments, bonds quietly confiscate purchasing power. You receive interest, but that interest buys less and less every year. And here's the key issue most people overlook. Retirement can last 25 or 30 years, sometimes longer. A portfolio that doesn't grow is not conservative, it's fragile. You need assets that expand with the economy and protect you from inflation. Bonds can play a role, but they cannot be the backbone of a retirement strategy. Stocks and real estate are essential because they grow. Mistake 2. Not owning enough income-producing assets. Some people retire with a large portfolio, sometimes $1 million or more, but it's invested entirely in growth stocks that don't pay dividends. Then retirement begins and the question becomes unavoidable. How do I live? The answer is usually sell shares. That means you're no longer living on what your assets produce. You're living on the assets themselves. Every withdrawal shrinks the portfolio. One bad market year early in retirement can do permanent damage. This is why income-producing assets matter so much. Dividends, rental income, and interest arrive without you having to sell anything. They create a paycheck replacement. That's the difference between stability and stress. Retirement works best when money comes to you instead of you having to extract it manually from your portfolio. Mistake 3, retiring with a mortgage. This one cannot be overstated. Retiring with a mortgage payment is one of the most damaging financial decisions a person can make. It dramatically raises the income you need every year and increases your exposure to market risk. If you're carrying a mortgage into retirement, your portfolio has to work harder just to cover fixed housing costs. That forces you into riskier investment behavior at the exact stage of life when flexibility matters most. The solution is straightforward, even if it's not always easy. Pay off the house first, then retire. If that means working a few extra years, those years often buy decades of peace of mind. Retirement is much easier when housing costs are low and predictable. Mistake 4, lack of diversification. Some people put everything into stocks. Others go all in on real estate. A few park nearly everything in safe assets. All of those approaches share the same flaw: concentration. Different assets perform well under different conditions. Diversification isn't about maximizing returns. It's about survival and consistency. It ensures that no single economic event can derail your entire retirement plan. That's why the framework includes 5 distinct asset types. Each one covers a different risk. Together, they're stronger than any single category alone. Mistake 5, starting too late. This is the most unforgiving mistake of all. You cannot build a durable retirement portfolio in 5 years. It takes time for dividends to grow, mortgages to be paid down, properties to appreciate, and index funds to compound. If you're in your 20s or 30s, time is your greatest advantage. Use it. If you're in your 40s, you need to act decisively and consistently. If you're in your 50s and haven't started, the margin for error is thin. You'll need focus, discipline, and urgency. And if you're in your 60s without these assets in place, the reality is harsh. You may need to work longer or significantly adjust expectations. There's no shortcut that replaces decades of compounding. That's not pessimism. That's arithmetic, a practical roadmap by age. The strategy changes depending on where you are in life. If you're in your 30s, focus on building your index fund and starting your dividend portfolio. Time is doing most of the work for you at this stage. Real estate can come later. If you're in your 40s, add income-producing real estate. Accelerate dividend investing. Start paying down the mortgage aggressively. Begin building inflation protection. If you're in your 50s, if you build these 5 assets consistently, retirement becomes manageable. Not extravagant necessarily, but secure, calm, predictable, free from constant financial anxiety. So here's the challenge. After reading this, don't just nod along. Take action today. One action. Buy your first dividend-paying stock. Invest in a low-cost index fund. Research rental properties or REITs. Purchase inflation-protected securities. Make an extra mortgage payment. One step today, another next week, another next month. That's how real portfolios are built. Not in dramatic moves, but through steady, repeated action. I've seen hundreds of retirements over a very long life. The pattern is always the same. The good retirements belong to people who built the right assets. The bad ones belong to people who didn't. The difference is preparation. By the time people reach retirement age, the outcome is usually already decided, not because of luck, not because of intelligence, but because of preparation or the lack of it. I've seen this play out repeatedly over decades. Some people enter retirement calm, confident, and in control. Others enter anxious, constrained, and worried about every dollar. The difference is almost never income alone. It's whether they built the right assets early enough and stayed disciplined long enough. Retirement doesn't reward last-minute effort. It rewards long-term structure. This is why I've been so insistent about these 5 assets. They are not trendy, they are not exciting, and they don't promise overnight results. But together, they form a system that works, one that can absorb shocks, adjust to inflation, and support you for decades. When markets crash, diversified dividend stocks continue paying. When inflation rises, rental income and inflation-protected securities adjust. When you live longer than expected, long-term growth assets keep compounding. When expenses spike, low housing costs give you room to breathe. Each asset solves a different problem. Together, they remove the need to guess, and that's the real goal of retirement planning, eliminating uncertainty. Most people don't fail because they make terrible decisions. They fail because they delay good ones. They assume they'll figure it out later. They assume there will be time. They assume something external will save them. Time is the one thing retirement planning does not forgive. Compounding only works when you give it years, sometimes decades, to operate. Dividend income only becomes powerful after it's been growing for a long time. Real estate only becomes meaningful after mortgages are paid down and rents have had time to rise. Index funds only reveal their full strength when left untouched through multiple market cycles. You cannot replicate that process at the end. That's why action matters more than information. You don't need to build everything at once. You don't need to be perfect. You don't need a complex plan. You need to start one account, one asset, one decision made deliberately, then another, week after week, year after year. This is how people quietly succeed at retirement while others wonder why it feels so hard. If you're younger, your advantage is time. Use it while it's available. If you're in mid-career, your advantage is earning power, directed intentionally. If you're nearing retirement, your advantage is clarity. Act decisively. What you cannot afford is inaction. Retirement is not an event. It's a phase of life that arrives whether you are ready or not. And when it arrives, it doesn't care about intentions. It only reflects preparation. I've watched people assume Social Security would carry them. It didn't. I've watched people rely entirely on market growth. One downturn changed everything. I've watched people underestimate inflation. It quietly eroded their lifestyle year after year. And I've watched others, quietly, methodically, build these exact assets and retire without fear. Not wealthy beyond measure, not extravagant, but secure, independent, at peace. That's what these 5 assets provide. Not luxury, not shortcuts, but dignity, stability, and control. So let me leave you with this final challenge. Don't wait for the right time. Don't wait for certainty. Don't wait until everything feels comfortable. Pick one asset today and act. Open the account. Make the purchase. Pay down the balance. Begin the process, then repeat. Your future retired self is not asking for perfection. They're asking for effort, applied early and consistently. Build the assets, stay disciplined, And when retirement arrives, meet it with confidence instead of fear. That's the path. Follow it. And retirement can become one of the most stable, rewarding phases of your life rather than one of the most stressful.